Hello, this is a follow-up and from some customers' requests who missed my analysis that was shown on CNBC on the 16th of March, where I primarily looked at the crude market and its connection between what was happening over the weekend before with OPEC's decision not to cut production, and primarily what I was emphasizing the fact was there's certain things that happened in spreads that also had what I call bad news, good action. So the market perceived initially to the story to be bearish, but then I was basically looking for the market to hold, what was a key area, and one of the things that we always look at iTraders. And subsequent to that, the market did actually rally later that day. First of all, just going to look at where we were on that day. So it was the 13th of March was the Friday, and the following day is where we open. We went lower and then we closed near the highs. And on the bigger picture, really the market had been pretty much going sideways. But within that, what I was talking about was the fact that while it appeared that not a great deal was going on, there had been some very significant behavior in the spreads. Now, the first spread that I looked at or showed was a continuation. It doesn't really show it up the top here, but what this is the first month or the spot month against the 36th month. So I'm looking at the spot to 3 years. And when the market had been falling previously, the contango or the discount of the spot to the 3-year price had got as low and had really over 3 different contracts traded as low as $32 to $35. However, coming into March, this spread had narrowed significantly, which suggested to me that the pressure that the spot month had been under for the previous 3 months was really coming to an end. This spread is now just the spot month against the secondary month, and the thing that I was highlighting here was the fact that while the picture had gone sideways and stabilized and come back to the long-term point of the fair value in terms of the previous 25 years, there was a big disincentive to get long, and this was due to the size of the contango of the spot to the second month. In 3 occasions it had gone to a contango of as much as $8, which meant that you were being penalized for being long to the tune of as much as 30 cents a day. However, once again, by the time we hit early March, this spread had recovered substantially, and so there no longer appeared to be anywhere near the same penalty for getting long. Now we look at the profile, and this was the profile from the low of the 12th of February coming into the OPEC meeting day. Now the thing that when we look at this distribution is that the control point, or the point of fair value, is at 44.16, and so what I was looking for was, having the price closed at 46.24 on the Friday, I was looking for when the pit opened that it would hold this control point. So we have what's called bad news, good action, or good news, bad action. Something I'm very, very interested in, because it means that the market is shrugging off news that should send it in one direction, which helps with the bullishness. Price actually went as low as 43, I think 43.20 in the early session in the morning, but by the time the pit hours opened, we opened here, came down to control perfectly, and then rallied very, very sharply on that trading day. These sorts of moments where we have distribution high-lows, and in this case control points, are always places where you can look to get involved. And in terms of thinking about where your stop loss could be, sometimes it can be a little bit wide. From a strategic point of view, you would have needed to trade below 42.56 into this vacuum to say that you were definitely wrong. However, once the market has held control and starts to rally higher in the E period, you have the opportunity to actually add to that position. Now, the other thing that I mentioned that got me very bullish about oil was the fact that actually, because of the massive rise we had in 2007, 2008, and then the complete collapse, what we effectively had from approximately $40 to $145 was vacuum up and vacuum down. And so this is the previous trend from the high that was made in July last year. And the point that I made was that really, once we start trading above $47, $48, there's very little in the way of major levels that you can look at in terms of resistance. We have some minor stuff up at 63, 64, but really there is nothing until a distribution high at $76 and a vacuum that takes us up to $86. So from a strategic point of view, what this meant was that the market could just simply vacuum back up again, and the only way that you would know that it wasn't doing that is once it built resistance based on its own momentum. Now I'm quickly just going to merge the profiles so we can see what happens subsequent to that. First thing is to merge the control point here, and once we've done that, we can see that price has made new highs into this rejection period here, which means that it's trying to form a higher distribution. It continues to do this for 2 days, and then we effectively gap higher. Now this shows us an acceleration and the fact that now we are definitely trading into a higher distribution. And what this means from a strategic point of view is that first of all we need to reference the gap, and secondly we have to know when we're wrong. Well, if price traded below 47.20, then it would be no longer trying to build a higher distribution. The importance of manipulating pit data so that you can actually see the gap is very, very important. But the other thing that is equally important is the rule that iTraders and I have associated with gaps. If price has not filled the gap after 5 days, then it is no longer part of your analysis. So why 5 days? The reason for 5 days is that short-term traders can't remember more than 5 days back. Many trends or accelerations of trends are defined by gaps, and that gap might not be filled for many months or even years. Now as I merge further in, it becomes clear that the gap has effectively created a vacuum between the top of what the distribution was before, around 48.80, and the new one that is trying to be built at 50.40. So in conclusion, the spreads were telling us that there was no penalty for being long, and the spreads were actually quite bullish. We also had the great classic example of bad news, good action, and that good action held at one of the most important points that we ever reference, which is control or fair value. And from then, price has continued to distribute higher, and until the market builds resistance based on its own momentum, there really isn't much in the way of resistance for at least another $10 and possibly as high as another $25.